11 burning questions answered. Is BITO the right Bitcoin investment for you? Hey everyone, and welcome to the channel. Today, we're diving deep into the world of Bitcoin and investment vehicles, specifically the ProShares Bitcoin Strategy ETF, also known as BITO. This popular ETF promises exposure to Bitcoin without directly owning it, but is it really all it's cracked up to be? We'll be asking the tough questions that matter to you, the savvy investor. Why did BITO launch when it did? Should you choose BITO over other Bitcoin options? What's the deal with futures contracts versus actual Bitcoin? And why are the specific contract weights kept hidden? We'll also explore BITO's strategy, its suitability for professional investors, and whether it truly lives up to its promises. So buckle up, get ready to learn, and decide for yourself, is BITO the right Bitcoin investment for you? Question 1. Why did the issuer choose to launch the ProShares Bitcoin Strategy ETF, BITO, at this particular time? Several factors likely contributed to ProShares' decision to launch BITO at that specific time. 1. Increased investor interest in Bitcoin. Bitcoin's price had reached record highs in 2021, generating significant mainstream interest and demand for institutional investment options. BITO offered a regulated and accessible way for investors to gain exposure to Bitcoin without directly owning it. 2. Regulatory approval and demand for a spot ETF. The Securities and Exchange Commission (SEC) had not yet approved a direct spot Bitcoin ETF, despite significant industry pressure. BITO, while not a spot ETF, provided a similar alternative, appealing to investors seeking exposure without regulatory hurdles. 3. First mover advantage. ProShares recognized the opportunity to be the first mover in the US market for a Bitcoin-linked ETF. This could potentially attract significant initial investment and generate brand recognition in a rapidly evolving market. 4. Market conditions and timing. Some analysts believe ProShares may have chosen the launch date based on technical analysis of Bitcoin's price chart and market sentiment. This could have been an attempt to maximize initial interest and potential returns for investors. 5. Competitive landscape. Several other companies were vying to launch Bitcoin ETFs, and ProShares likely aimed to preempt competitors by getting their product to market first. Question 2. Why should investors consider BITO as opposed to other investment vehicles for gaining exposure to Bitcoin? While BITO isn't the only option for gaining Bitcoin exposure, there are several reasons investors might consider it over other alternatives. Regulation and accessibility. Unlike directly owning Bitcoin, BITO is a regulated ETF traded on major exchanges. This offers greater security, transparency, and accessibility for many investors, especially those unfamiliar with cryptocurrency platforms. Convenience and liquidity. BITO trades like a traditional stock, allowing investors to easily buy and sell shares through their existing brokerage accounts. This can be more convenient than setting up and managing a cryptocurrency wallet. BITO also boasts good liquidity, facilitating quick and efficient transactions. Diversification within Bitcoin. BITO invests in multiple Bitcoin futures contracts, offering some diversification within its Bitcoin exposure. This can help mitigate the impact of fluctuations in any single contract's price. Potential tax advantages here. Depending on your location and tax strategy, BITO might offer some tax advantages compared to directly owning Bitcoin. For example, holding BITO in a tax-advantaged account like an IRA might provide tax benefits not available with direct Bitcoin ownership. Potential for lower fees. While BITO charges management fees, some investors might find them lower than the fees associated with certain cryptocurrency exchanges or trading platforms. Limited voting rights. Unlike directly owning Bitcoin, BITO doesn't grant voting rights on the Bitcoin network. While this might be a drawback for some, it can simplify the investment process for those primarily interested in price exposure without the complexities of network governance. Question 3. Why does BITO use Bitcoin futures contracts rather than directly holding physical Bitcoin? BITO's decision to use Bitcoin futures contracts instead of directly holding physical Bitcoin stems from several key factors. Regulatory constraints. As of October 2024, the SEC hasn't approved a spot Bitcoin ETF in the US. This means ETFs cannot directly hold the underlying asset, Bitcoin. BITO navigates this by utilizing futures contracts, which are regulated financial instruments that track the price of Bitcoin without actually owning it. Investment ease and accessibility. Futures contracts offer a more familiar and accessible investment vehicle for many traditional investors. They can be bought and sold on established exchanges, eliminating the need for setting up and managing cryptocurrency wallets, which can be complex for some investors. Liquidity and efficiency. Bitcoin futures contracts have higher trading volume and liquidity compared to buying and selling actual Bitcoin on cryptocurrency exchanges. This allows BITO to track the price of Bitcoin more efficiently and offer investors quicker and smoother transactions. Risk management potential. Futures contracts allow for various hedging strategies that BITO can utilize to manage some risks associated with Bitcoin's volatility. These strategies can help mitigate the impact of contango and backwardation, which can affect BITO's performance compared to Bitcoin's spot price. Regulatory compliance and reporting. Trading Bitcoin futures contracts adheres to existing regulations and reporting requirements. This allows BITO to operate within established financial frameworks, enhancing its transparency and potentially appealing to institutional investors with stricter compliance needs. However, it's important to remember that 1. Using futures contracts introduces tracking errors, meaning BITO's performance might not perfectly mirror Bitcoin's spot price due to factors like contango and rolling costs. 2. BITO doesn't offer voting rights on the Bitcoin network, unlike directly owning Bitcoin. 3. Futures contracts are derivatives and carry their own set of risks, such as counterparty risk and potential margin calls. Ultimately, BITO's choice to use futures contracts reflects its aim to provide a regulated, accessible, and efficient way for investors to gain exposure to Bitcoin within the current regulatory constraints. However, it's crucial to understand the trade-offs and risks involved before investing in BITO or any other Bitcoin-linked product. Question 4. Why does BITO primarily rely on near-month and next-month contracts? There are several key reasons why BITO primarily relies on near-month and next-month Bitcoin futures contracts. 1. Tracking price movements accurately. Near-month and next-month contracts have the closest expiry dates to the current date, meaning their prices tend to reflect the current spot price of Bitcoin more closely. This allows BITO to track Bitcoin's price movements more accurately in the short term. 2. Liquidity and trading efficiency. These contracts typically have the highest trading volume and liquidity compared to longer-dated contracts. This ensures BITO can efficiently buy and sell contracts to maintain its desired exposure and track Bitcoin's price movements. 3. Risk management. Shorter-dated contracts have less exposure to contango, a condition where futures prices are higher than the expected spot price at expiry. This helps mitigate the potential negative impact of contango on BITO's performance compared to Bitcoin's spot price. 4. Flexibility and adjustment. By focusing on near-month and next-month contracts, BITO can adjust its holdings more frequently based on market conditions and the issuer's risk management strategies. This allows for quicker adaptation to changing market dynamics. 5. Regulatory considerations. Some regulations might limit the maximum duration of futures contracts that certain investment vehicles can hold. Focusing on near-month and next-month contracts ensures compliance with these regulations. However, relying solely on near-month and next-month contracts has some drawbacks. 1. Increased rolling costs. BITO needs to constantly roll over expiring contracts into new ones, incurring transaction costs that can erode its returns over time. 2. Limited exposure to long-term trends. Focusing on shorter-dated contracts may limit BITO's ability to capture potential long-term trends in the Bitcoin market. 3. Increased volatility. Shorter-term contracts can be more sensitive to short-term price fluctuations, potentially impacting BITO's volatility compared to longer-dated contracts. Ultimately, the choice of contract duration is a balancing act between tracking accuracy, liquidity, risk management, and potential drawbacks. ProShares, the issuer of BITO, continuously monitors market conditions and adjusts their strategy as needed to achieve the desired objectives, within the constraints and regulations they face. Question 5. Why does the issuer not disclose the specific weightings of different futures contracts within BITO's holdings? The issuer of BITO, ProShares, chooses not to disclose the specific weightings of different futures contracts within BITO's holdings for several reasons. 1. Transparency versus competitive advantage. While transparency is crucial for investors, ProShares might argue that disclosing the exact weightings could give away their investment strategy and potentially provide an unfair advantage to competitors who could mimic their approach. 2. Dynamic management and adjustments. BITO's holdings are constantly adjusted due to contract rollovers and potential strategic decisions. Disclosing the specific weightings at any given moment might not be entirely representative, as they could change rapidly based on market conditions. 3. Regulatory requirements. While BITO is subject to reporting requirements, the specific weightings of individual contracts might not fall under mandatory disclosures, especially if they are part of a broader investment strategy. 4. Focus on overall performance. ProShares might argue that investors should primarily focus on BITO's overall performance and track record, rather than getting hung up on the specific weightings of individual contracts, which can be complex and subject to change. 5. Security concerns. Disclosing detailed information about BITO's holdings could potentially attract malicious actors seeking to manipulate the underlying futures market or exploit any vulnerabilities in the ETF strategy. However, this lack of transparency can also be seen as a drawback here. 1. Some investors might feel less comfortable investing in BITO without knowing the exact composition of its holdings and the rationale behind the weightings. 2. It can be challenging for investors to fully assess the risks associated with BITO without a clear understanding of its underlying exposure to different futures contracts. Ultimately, the decision to not disclose specific weightings reflects a trade-off between transparency and other considerations. Investors should weigh these factors carefully and conduct their own research to determine if BITO aligns with their risk tolerance and investment goals. Question 6. Why does the issuer believe that Bitcoin futures contracts are an appropriate investment vehicle for tracking the price movements of Bitcoin? While ProShares, the issuer of BITO, doesn't explicitly state their personal beliefs, their decision to use Bitcoin futures contracts for tracking price movements stems from several key factors. 1. Regulatory landscape. Currently, the SEC hasn't approved a spot Bitcoin ETF in the US. This means ETFs cannot directly hold the underlying asset. Futures contracts offer a regulated alternative, allowing BITO to function within existing regulatory frameworks. 2. Tracking efficiency. Near-month and next-month futures contracts closely mirror the current spot price of Bitcoin, allowing BITO to track immediate price movements effectively. This can be attractive to investors seeking short-term exposure. 3. Liquidity and accessibility. These contracts have high trading volume and liquidity compared to buying and selling actual Bitcoin on exchanges. This facilitates efficient transactions and makes BITO accessible to investors familiar with traditional markets. 4. Risk management potential. Futures allow for hedging strategies to manage volatility and contango, a condition where futures prices are higher than the expected spot price at expiry. While not perfect, this can help BITO mitigate some risks associated with Bitcoin's price fluctuations. 5. Operational convenience. Futures contracts are easier to manage compared to directly holding Bitcoin, eliminating the need for setting up and securing cryptocurrency wallets. This can be appealing to investors unfamiliar with the complexities of crypto platforms. However, it's crucial to remember: 1. Futures contracts introduce tracking errors, meaning BITO's performance might not perfectly mirror Bitcoin's spot price due to contango and rolling costs. 2. BITO doesn't offer voting rights on the Bitcoin network, unlike directly owning Bitcoin. 3. Futures contracts are derivatives and carry their own set of risks, such as counterparty risk and potential margin calls. Ultimately, ProShares' choice reflects their perspective on the current regulatory landscape and their aim to provide an accessible way for investors to gain Bitcoin exposure within those limitations. It's important to understand the trade-offs and risks involved before investing in BITO or any other Bitcoin-linked product.